Okay. I hope you can see the screen. Since I have already exited the Zoom screen, I can't actually see the chats. All right. So if you have any doubts, you can unmute yourself and ask right away. Okay. No problem at all. Okay. So the standard that we are dealing today is IFRS 15 revenue from contract with customers. So the specialty about this standard is that this is such a common standard. Okay. Also, the one thing that has been asked in interviews for many since many long time. All right. So if you are a professional dealing with the IFRS, if you are any ACCA, or if you are doing any IFRS certification course, or you are linked to any professional body, when you are in an interview, the most commonly asked standard is IFRS 15, obviously, because a business runs on revenue, right? So IFRS 15 in itself is a very important standard when you are going to go to a business and start your career, okay? And business as in the company, all right? So all the companies in their interview actually include this standard as a interview norm. Otherwise, they want the candidates to at least know the standard. Understood? Okay, then we'll start. So, according to the definition, okay, the IFRS 15 is the income arising in the course of entities' ordinary activities. All right. So, if you are a business dealing with an electronic equipment, the revenue that you raise while you sell the electronic equipment is your revenue. Okay. All right. The income that you raise from selling those electronic equipments is your revenue. Okay. If you are a real estate business, if you're going to sell your buildings or lands, or you're going to rent out the properties, then that particular income generated is your revenue. Okay. And we can't actually record those things in our own way because there is a prescribed standard telling you how these things should be recorded in your accounting transactions, all right, or in your how this particular thing would be presented in your in your FS. All right, so this is the definition. So definition is basically income that is arising out of the normal course of a business. All right, I hope you understand. Okay, just a moment. Now, see, when they okay, someone else has joined. I'll just give a quick recap. We have just started the standard, okay? And IFRS 15 is something that is being mostly asked on interviews, and it is a main standard which covers everything that a business deals with. Okay, so it mainly deals with the income that the business raises while conducting as normal course of activities. All right. Now, if you're going to learn IFRS 15, you must know that it is a contract. It is a binding contract between a customer, okay, and the one who is selling that product, right? So it is an agreement between two parties, okay, and these two parties would create rights and obligations. All right. Now, what is the rights and obligations that is there? Okay. See, if you're going to buy something, okay, you're particularly buying its ownership, right? Let's say we're going to buy an iPhone, okay? If you're going to buy it, you're going to own it, right? Now, this does so that is the owner receives. That means the owner receives the good, all right? Now, if you're going to buy, they're not going to sell you for free, right? You have to pay something, okay? And that is your obligation to pay, and that is what the customer pays. Okay, now who's the customer? Okay, so customer is particularly those people, okay, for whom the good is supposed to be transferred, okay, and this person would pay something in return. All right, and that something has a different word, or if we give a term to that something, we say it as a consideration. Okay, So the customer is going to get the goods or services that he has demanded in exchange for the consideration that the company gets. Okay. Now, there are certain rules and regulations to every standard, right? We can't just actually, observe something and say that this is in this standard or this is revenue, right? So before considering anything at all, okay, the first thing that we do is we have to make sure everything is according to the criteria of the standard, okay? So when I say standard, you must understand I'm talking about all the rules and regulations that are there so that we can account for something in the commerce or business field, right? Okay, and this particular thing is going to reflect in the FS. Okay, so what are the criteria related to IFRS 15? First one is that identify contract with customer. Okay, so first and foremost thing is that we have to identify in which contract the customer is engaged in. Okay, whether it is whether it is to buy an electronic equipment, okay, whether it is to rent a property, right? So we have to understand what type of thing that we are selling, okay, and what does the customer wants from it, right? So it is to identify the contract with the customers, and that is the first criteria. Second one, identify performance obligation. Now, what is a performance obligation? Okay, suppose we are, a big, maybe a big electronic company, all right? So our company sells, let's just say, mobile phones, smartphones. Okay. So this is the product that we offer, right? Okay. And let's say we are a manufacturer, all right? And there is a retail company, A Limited, that is going to purchase in bulk the amount, bulk the mobile phones, all right? So this person actually paid you, let's say, $10,000. Okay. So when this person has paid you the $10,000, then it becomes obligated upon you to transfer these mobile phones to the A Limited company, right? So this is your performance obligation. So whatever the goods is being demanded, you have to deliver it. Okay, that is the performance obligation. This is in case of the mobile phones. It can be any other thing. You can be involved in a construction business. You can be involved in a real estate business, right? You can be involved in any other manufacturing business. So whatever is the case, what you're providing is to be provided, right? So that particular obligation is the performance obligation. Understood? Next one, transfer price. Transaction price, sorry. Okay. So this particular thing that you do, the performance obligation that you do, it's not for free, right? So whatever the product is going to be bought, it should have a price attached to it, and that is the transaction price. That's all. Okay. The next fourth one, allocate transaction price to performance obligation. See, this particular step, I'm going to give it in a box, and there is a reason for it. Okay. See, not always does business provide products at the same price it has fixed, right? Sometimes it might give things for offers, right? It might discount things and give, right? Okay. But generally, from the point of view of the business doesn't actually incur any loss. Okay. Because they are going to allocate the transaction price into those products that they have provided, whether it is on an offer price or whether it is on a discounted price, it is going to be accounted for individually, okay, in its own price. That means the business is never going to let anything out for free, right? See, we see the sales that are offered over the outlets, right? But actually, in reality, when you know the things, you know that the company is going to gain something out of it. They are not going to give things for free, right? So that is the fourth step that we need. Okay, when we do a problem, it would be more clearer. Okay, the last one. Okay, now you know the performance obligation that we did that we identified earlier, right? Maybe it is to deliver any products, right? So when do we record the revenue? As soon as both the parties meet their rights and obligation. That means the person who is buying the product gets the product, okay, and at that moment the business would have to record the revenue. Okay, so at the point where the products are being transferred to the customer, the business can actually record the revenue. Now it isn't necessary that the business might actually receive the cash. It can be a debtor, okay, or the receivables, let's say. Okay, so it can be a receivables, but the business is allowed to record those things as soon as they are going to fulfill their part of the bargain. That means the product is delivered. Understood? If you have any doubts, you can unmute yourself and ask. Okay. Since I have exited that screen from the Zoom, I can't actually go and check the chats. All right. So if you have any doubts, you can unmute yourself and ask. Any doubts? Okay, so these criteria I have mentioned is actually the same thing that is going to let you recognize whether or not an amount can be taken under revenue. Clear? Okay, so if any of these criteria doesn't meet, you can't record the revenue. That's all. That is a general rule of thumb. Understood? No? Now let's take an example. ABC Limited entered into a contract with the customer. All right, the contract is such that it has to give a car for $2,000. Okay, and the service is going to be free. Okay, and the service is going to be provided for 2 years. Okay, and total contract price is 2,000. So this is the the quotation that we offer to the client. Okay, now this is usually not the case that the company deals with the products. Okay, there is another standard price that is being set in the company in order to provide these products. All right, so that price is called stand-alone price. All right, so what happens with the standalone price? Let's see. So without this particular offer, okay, the company is going to provide car for 1,800, and the company is going to charge service for 2 years as 400. All right, and the total revenue is going to be 2,200. Okay, now we have to show how these revenue is going to be recorded. Okay, I hope the answer is clear. Just a moment. Okay, let's see. Okay, so this is the question. Let's see how we solve the question. Okay, for the time being, since you have to be thorough with the criteria, let's just have a quick recap of the criteria by the above question. All right, so answer, let's see. Identify the contract. So do you see the contract? Identifying the contract is the first criteria. Can you see the contract? Yes, right. The contract is to provide car for 2,000, a service free for 2 years, and the contract is going to be priced at 2,000. Okay. So you identified the contract. Second one, do you identify the performance obligation? Is the performance obligation identified? Yes, right? You have to deliver the car. You have to give service for 2 years. So performance obligation is also met. Okay, that is, you are going to give car, you are going to provide 2 years service. Okay, so this is the performance obligation. Now the third one is transaction price. So do you have the transaction price? Yes, 2000, right? So transaction price is also there, that is 2000. So third obligation is, sorry, third criteria is also met. Fourth one, allocate see, is the transaction price different from the standalone price? Yes, right? So you have to follow the fourth one. That is, you're going to allocate, okay, the transaction price to the performance obligation. Understood? So you're going to divide the amount that is actually to be priced. Clear? That is actually to be recorded. Understood? Okay, let's see. So car and the service. Okay, and the standard price is given. How much is that? 1800 and 400, right? So total it is 2200. The next thing that you do is you're going to find the percentage. Okay, and the percentage is done like, see, out of the 1800, out of 2200, how much is it? Okay, into 100. And also here 400 out of 2000, how 2200, how much is it? Okay, so here you would get 82 percentage, right? So 82 percentage as in the price from the total revenue. Okay, if you take 82 percentage out of it, it belongs to the car. Okay, and rest 18 percentage belongs to service. So this is the allocation that is being provided towards the standalone price. Okay, now you are going to take this percentage and apply it over the contract price. Understood? So that is actually called as transaction price allocated. Clear? And you're going to allocate that transaction price over the 2000. Okay, so let's see. So first price is going to be 2000 into 82 percentage. Let's see. So if you do 2000 into 0.82, you are going to get 1640. Okay, and you're going to get rest of the 360 as service price, and together it would cost you 2000. Okay, now you must understand this 360 is not given in 1 year. This 360 is divided into 2 and given each year. That is 180 per year. Okay. Now, what is the fifth criteria? You're going to record the revenue once the obligation is met. Okay. Now, let's just assume the performance obligation is met. Then what are you going to do? Okay. So the first year, your revenue is going to be 1640 plus the 180 of service. Understood? Okay. 1640 plus 180 of service, that is 1820. And the second year, you're going to recognize only the service alone. That is the remaining of 180. So this is your split of the IFRS 15 transactions. Okay. Now let's move further. So this is about the calculation. So you now know that nothing is for free as in terms of accounts. Okay. As in terms of a business perspective, because we are going to charge something over it. Understood? Now, don't go around for offer prices assuming that it is for free. All right. Now, what are the common IFRS 15 transactions? Okay. Just a moment. Just a moment. I'll be back. Okay. Sorry about that. So next one, is the common IFRS 15 transactions that you have seen in your daily life, or you have known, as you have studied things, right? So first one is consignment arrangement. All right. So for the consignment arrangement, there are mainly three parties. Okay. One is the principal, the other is the agent, and the last one is the customer. This is a chain. Okay. So what does the principal do? Principal would transfer their goods and services to the agent. Okay. So the principal is going to be the owner of the business. Okay. But instead of dealing with the customers directly, they are going to use agents. Okay. Or in common terms, let's say franchising, right? See, there is a manufacturing industry for every car industries, right? Everyone has a manufacturing place, right? But they don't actually deliver goods to the customers directly. The cars are not, directly taken from the manufacturer to the customer, right? There is an agent that deals with it, okay? And they have got so many shops and they deal with car whoever they pleases to select, right? So there is a gap between the principal, that is the owner, and the customers, right? Okay. This particular setup is the consignment arrangement. Okay. So when the principal gives the agent or transfers the goods to the agent, it is not actually a sale but a transfer. Okay. It is just a transfer so that the agent can sell it to the customers, right? So when the agent finally sells the product, okay, then the sale is made. Okay, then we are going to recognize the transaction. Now, when the sale is made, the principal is bound to give agent a commission. Okay, and after that commission, okay, the principal is going to get their net amount of the revenue. Okay, and this is the same thing that happens with the car dealers and other manufacturers. Understood? Okay, next one is the factoring arrangement. Okay, so what is a factoring arrangement? Suppose your company has many receivables. All right, there is trade receivables in your company, and this particular receivables is an asset, right? It is a current asset. Okay, suppose your company is in need of some cash. Okay, but you're not able to actually, collect those from your customers. Okay, so you want the cash immediately. So what you do is you're going to take these receivables, okay, and you're going to sell it to someone else. Okay, that someone else is called the factor. All right, so that someone else is called the factor. Okay, and this factor is going to give maybe an 8,300 as an advance to the company out of the 10,000 that is being sold. Clear? And factor would be then responsible for collecting all the receivables. Okay. Now, when you see the factoring arrangement, there are two types of factoring arrangement. One is the recourse factoring and the other is the non-recourse factoring. Okay. Now, under recourse factoring, the bad debt is going to be borne by the company itself. Okay. That means if the company is going to sell this 10,000 to a factor, okay, if there is any bad debt, the company itself is going to bear that. Clear? So that means the sale is not actually happened, right? You're not going to sell the sell the receivables. This is actually a system of loan. Understood? So it is a secured loan. It is not going to be treated as a revenue. Okay. And this secured loan is going to be secured with your trade receivables. Understood? Now, non-recourse factoring. See, in non-recourse factoring, when you're going to sell the goods, sell the 10,000 receivables, you're actually transferring all the risk and control related with the receivables. That means you have no right over those things once it's done. Okay, so you're going to deduct those things from your receivables. You're going to add the cash back in, okay, and the gain or loss would be realized. Clear? In most of the cases, it is loss only. Okay, next arrangement is sale and repurchase arrangement. Okay, next arrangement is sale and repurchase arrangement. So here, suppose your company has an asset. Okay, that asset is worth $10,000. The company sold that asset to the bank. Okay, and the bank gave them $12,000. Sorry, sold the asset to the bank for $10,000. Let's say. Okay, now this particular asset, now as of now the bank possesses it, right? But maybe 2 years later the bank can give that asset back for 12,000, let's see. So bear in mind, it has been sold for 10,000. Okay, and the bank after 2 years is ready to give you that back, but for 12,000. Okay, here also we are going to divide the sale arrangement into two categories. Okay, the first category is where, okay, the repurchase is low. Okay, chances of repurchasing is low. The second category is where the chances of repurchasing is high. Okay, so how do we record it? If the chance of repurchase is very low, that means we're going to assume that the asset is actually sold. All right, so you're going to deduct that amount from the asset, you're going to add it to the cash. Okay, and any gain or loss is going to be realized. Okay. Now, when the repurchase is very high, it's very highly or it's very probable that you're going to buy back the asset, right? So you have not actually sold the asset, but you have taken loan from the bank. Okay. So we are going to assume that this particular thing that you receive from the bank is actually a loan. Okay, now if the repurchase is very high, then it is going to be for more than the amount that you sold for, right? So whatever the excess amount is there, you're going to take it as interest. Okay, in this case, it is going to be a 2-year interest. And total money is going to be your total loan. Understood? Now, the next one is the bill and hold arrangement. Okay, so in bill and hold arrangement, what happens is that maybe you purchased something from the the company. Okay, but for some reason you're not able to transfer that goods or services to the customer. All right, the customer purchased something, but due to some reason the customer says us, okay, do one thing, don't deliver the goods now. Okay, maybe deliver it 3 months later. In this case, okay, you're going to have to take that particular goods and services and store it into the warehouse until the customer says that it can be transferred, right? Of course, you will charge something for it, but this arrangement is called as bill and hold arrangement. Okay. In any case, you are just going to study these things for, for knowledge purpose. This is not going to be the one that you're dealing with under this standard. Okay. It's just for knowledge purpose. Just a moment. Okay. The fifth one is warranty. So warranty is something that you have already learned in IAS 37 provisions. Okay. So since we are not dealing with IAS 37 provision, I'm not going to go deeper into it. Okay. Now, the next one is the construction contract. Okay. So this is something that is really important apart from the, standalone prices. This is the next thing that is very important. Okay. So what is a construction contract? Construction contract is particularly dealt with when you are in a construction industry. Okay, so that means if your company is dealing with construction, you're going to record your construction revenue according to this particular standard. All right, that is called the entire thing is called construction contract. Okay, and in construction contract, we don't have a physical asset that is being already completed and transferred, right? We are going to they are going to be completed over the course of time. Okay, hence the revenue is also going to be recorded according to the stage of completion. Okay, so that means if you are building a building for a customer, see, you can't wait for that much long period, that is by the time the building is completed and then you collect your money. No, because the customer might, turn bad debt. Okay, right? So you can't take the risk, but you have to collect your revenue. And this revenue is collected on the basis of stage of completion. Okay. Now, this stage of completion is going to be divided into two categories. Okay. So the first category is input method. Okay. And the second category is output or work certified method. All right. Now, under the first category, that is the input method, all you're going to look towards is whether how much of the product have been used in while the construction is taking place. Okay. Whereas in the output method, what you're going to do is you're going to account for whatever is being completed. Okay. So both are two things, right? Here you're going to take things that are used. Here you're going to take things that are produced. Understood? Okay, no? Now, under input method, the equation is cost incurred to date divided by total cost into 100. Okay? Cost incurred to date divided by total cost into 100. Okay? Now, under output method, the equation is work certified divided by total contract revenue into 100. Okay, work certified divided by total contract revenue into 100. Now, what does this contract revenue include? Okay, or what is the contract revenue consist of? First one, all the amounts that have been initially agreed with the customer. Okay, that means everything that is there initially would be there. Okay, now in the second case, there might be instances where the customers might want more of the construction to be taken place. Maybe it has an extension to the existing plan. So all the variations and all the works or any claims that are there would be considered. The third one is that if there is any incentives, okay, or the discounts that are being provided is there. The fourth one is any penalty. If so, the customer is going to back out from the contract. Okay, so these are your revenue. Now is the contract cost. So how much does it go into the cost? First one, you're going to take all the costs that are directly attributable towards the contract. That is the material cost, right? If you want to build a building, you want the cement, the sand, the bricks, right? So everything that is directly attributed towards the construction would be taken. The second one, all the generally allocated things. That means the salary of the supervisor, the salary of the engineer. So everything, the wages of the employees. Okay, so everything would be taken. The third one, if there is any such cost which is going to be charged to the customers, that is especially related with this contract, you're going to take that as well. Okay. Now, what is the recognition and measurement? So under SOPL, you're going to find out the contract outcome. Now, how do you find out the contract outcome? You're going to take the total contract revenue. So this is an SOPL content, all right? So in order to take things to the SOPL, you need the total contract revenue. Okay. And as in any case, you're going to deduct the cost and then find the contract outcome, that is the profit or loss from the contract. So you're going to take the total contract revenue that is being agreed upon. You're going to deduct the contract cost that you have incurred, and then you are going to reach the contract outcome. Now, when I say contract cost, it is going to be the cost incurred till date. Now, what is the cost incurred till date? Suppose the construction is in the middle, right? So up to the date, okay, up to the date, it is cost incurred till date, and you would have further cost incurred with the asset, right? So the future cost is the cost to complete, okay? So, in order to make this shorter, we say this as CITD and this is CTC. Okay, so CITD plus CTC is going to be the total cost. Understood? The next one is the contract outcome. That is the second measurement, contract outcome. Now, when you are going to measure this contract outcome, there are two things. Okay, there are two things to be considered. Sometimes, whichever property that you're planning to construct, there are actually reliable estimates that are found. Okay, that means all the costs can be, identified with certainty. That means you can actually take an estimate which is reliable or usable, right? But in some cases, maybe in the remote areas, when you're going to construct a company, or construct a building, there are certain factors that are always uncertain. Maybe just for an example, you are planning to construct a building in North Korea, right? So it is nearly impossible. If at all you manage to get a contract or get a quotation, everything would be unstable, right? So that is actually a contract which cannot be reliably estimated. Understood? Okay, in that case, there is a separate treatment. In this case, there is a separate treatment. Understood? So for the contracts where you can actually find the reliable estimate, you're going to divide the contract into two categories. Okay. So the first category is going to be profit making. Okay. And the second category is going to be loss making. Okay. So if it is a profit making contract, you're going to find the revenue. Okay, and you're going to find the cost. Okay, and this is going to be according to the stages of completion. That means you're going to apply this particular formula, and then you're going to find the amount of completion, and then you're going to apply that amount towards the revenue and towards the contract cost, and then the contract outcome would be found. Okay, in the next case is whether the company is into a contract which is loss making and it is certain that it is going to be a loss. Then in that case, that loss is not going to be divided or recovered over time. No, it is going to be recovered immediately. Okay, so even before the construction take place, okay, or in the middle of construction, you already know it is a loss making contract. You're going to recognize the loss immediately. Clear? Now, in the case of the contracts where we can't actually have the reliable estimate, what you're going to do is you're going to recognize whatever has incurred. That means all the revenue you incurred, you got till date, and all the cost you incurred got till date. Okay, and in this case, there is no P&L is recorded. Okay, there is no P&L that is being recorded. So this is the SOPL case. Now, in the SOFP, you're going to follow this equation in order to record the things. Okay, so you have to provide contract asset. For example, like you show trade receivables, you have contract asset. Okay, and this is going to be the gross revenue that is being due from the customers. Okay, so since the construction doesn't take place fully, you have to record gross revenue. Okay, and how do you do that? You're going to take the cost incurred till date, you're going to add the profit or loss till date, and if there is any progress billings that the customer has paid, you're going to deduct that, and then you have the contract asset. Okay, now suppose you have computed this equation. Okay, and the amount that you got is negative. If it is a negative amount, instead of contract asset, you have to record contract liability. Clear? And it would be taken in liability side of the SOFP. Now, there is something called trade receivables, right? At the end of the contract, if you're going to receive all the things in cash, or if you're going to receive all the money that you are owed, how do you calculate that? You're going to take the progress billings and you're going to deduct the cash receipt. Okay, so this is the very last topic of the IFRS 15. I hope the class was very useful to you guys. If you have any doubts, you can ask me right away. Are there any doubts, guys? Is it good? Give me a thumbs up if the class went well. Hello? Since I can't hear you guys, okay, you can actually, give your feedbacks over the chats. Class was good, okay. The recordings and the notes would be sent to you if on demand, okay. Thank you, guys. It was a wonderful session. Thank you so much. Thank you.
Thank you, ma'am. Thank you.
Thank you.